Hi, this is Randy Finney with Right Side of the Chart, and today's Friday, May 5th, 2017. Time for a market update. I haven't done a video update in the broad markets in a while, mostly because not much has changed. This is really um, I'm struggling for the right words here. Let's just say an impressive and an unusual market. Very resilient market lately. As far as holding up and despite of bearish technicals. Then again, the trend is up. The primary trend is up. What I wanted to start out with is point out that the near-term trend is still sideways. All the major indexes, we'll start with the S&P 500 here, which is by far much more representative than the QQQ, which I talk about. That one is up about 3% or so from its recent highs. It broke out the new highs. But if there's one index you're going to use for the stock market, you can use the Wilshire 5000. That's pretty representative, but most people go by the S&P 500. It's much more representative of the entire stock market than the QQQ because it has a lot more sectors and diversification within there, and especially it's not so overweighted with the top components such as QQQ is. So with that being said, at this point the market's still topped on March 1st. So the point I'm trying to impress is this has been a stalemate for both bulls and bears alike. Yes, the primary trend is up. So if you have to give it to anybody, you give it to the bulls because they haven't been able to pull this market down yet. But at the end of the day, this has been frustrating trading, at least those trading the broad markets or investors sitting there because you've seen your money go nowhere. Again, you can see March 1st highs. We zoom in. We're still not there yet. We're slightly above them. At this point, I'll just say it. My expectation, I lean towards a pop to new highs. Normally, when you get this close to new highs, you get that breakout. It's almost like a magnet. They punch through. And I'll give you my thoughts here in a second, but I did want to point out again from March 1st, today is May 5th. That's 3 months of, 2 months of sideways trading action and a go nowhere market. And I'll just go over the couple others real quick. Here's the Qs. Here's that little sideways trading range. It was in for a few months, so the Qs went nowhere, but recently did break out the new highs. And as I've talked about, that's about a 3% run up from where we broke out, where the previous highs were. The top of that range, and as I mentioned, that's attributed largely to just a handful of stocks, which we'll cover here in the end. This video won't be very long, so there's a story. And again, the QQQ is not representative of the U.S. economy. It is pretty much a tech fund with an Amazon kicker, is what I refer to QQQ as, based on the almost, the majority, almost all the top holdings that make up 50% of the index, the top 10, are mostly tech companies with Amazon in there as one of the bigger weighted companies. And here's IWM. So you can see if you're a small cap trading the small caps, pretty impressive. You've gone absolutely nowhere, literally for, 6 months now, all the way back to December 9th, and when IWM topped. That's exactly where we're trading today. So there it is. We've gone down a little, up a little, within an extremely tight trading range. So be thine bull or bear, you cannot declare victory if you're trading the small caps yet. If you've been long for most of this run, then sure, you haven't given any profits back. But let's just get to the charts, and I'll tell you what I think we're gonna see here soon. All right, I'll start with IWM because we're already there. Here's my board, gone over many times, so I won't go over all the history of divergent highs and corrections, but again, they've all played out. Even this one back here that I pointed out, that was still good for a 6% drop, so certainly a tradable drop, but it really just put us down at the bottom of that trading range with a little false breakout there. We had a little false breakout here and here at the top of the range, but we're back inside the range. So two false breakouts. And the reason this one failed, and I stated as such at the time that it probably would when we broke out the new highs on IWM, because it was a divergent high. You can look down here on the daily chart. We had clear negative divergence both on the daily chart that we're looking at as well as a 60-minute time frame. Fast forward to today, or most recently, we broke out again to new highs, and as suspected, that new high failed because it was a divergent high. Now, just all we need is just a couple ticks down. one red day next week, or a couple red days, or even sideways trading, and it will have confirmed this divergence. By confirmed, I mean you can see here this blue line, the PPO line, is about to cross over the signal line, the 9 EMA, that white line. Once we get that bearish crossover, if the lines don't bounce here and the PPO turn back up, we'll get a bearish crossover, and then at this point, that marks that high that we recently had will prove to be a divergent high. And again, this is just my book, if you will. I've used this term confirmed because when the indicators are moving higher, like in the case of PPO, they can continue to go higher. But typically, when you see the PPO line roll over like that, like you did here, sometimes it will bounce. And there you see it bounced and didn't make a crossover, but it did finally made a crossover here. And so now you have a very large divergent high. And the point that I'm trying to make here is this divergent high, this divergence is even larger in scope than this divergence here. So therefore, we're setting up for a powerful move. I still think it'll be to the downside. It's been frustrating because, I've been expecting that. I thought this would have been the trigger. I haven't been proved wrong yet, but I haven't been proved right either. That's the thing about being early and wrong are two different things in my book. Being wrong is going long or short on a trade and then being stopped out because that trade moved against you beyond your stop threshold. Being early means you got in, it may have taken a while to play out, didn't play out right away, it might have looked like it wasn't going to play out, but as long as the market or the stock you're trading didn't exceed any reasonable stop or move, you're just early in time. And that's pretty much what this call for a correction in the market has been so far. As I mentioned, the QQQ is only about 3% higher than where it was months ago. The SPY is still below where it was 2 months ago. So therefore, it's been a go nowhere market. And the indicators like we're looking at here, this negative divergence is pretty clean. Tells me that this trading range will probably resolve to the downside. While I'm on IWM, I know a lot of you inquire about it. I still have a position I've been in forever on that, it seems like now. And it goes up and down. Just in the last few days, I've gone to break even to, I was at a loss here because I was scaling into the top of the range, then profitable again. And I'm about flat on that right now because we're right back at the top of that range. I don't see a lot in the 60-minute charts here to get a good feel on where IWM is going. So again, I revert back to the bigger picture, which is more technically significant. So what I'm trying to say is it's hard for me to tell from the 15 or 60-minute charts where we go over the next few days, but this chart tells me there's a very strong chance that the next, let's say 10% move will be to the downside before it will to the upside. And now we'll go to SPY and we'll wrap up with QQQ. Here's a SPY daily chart. You can see the, look down here, you can see the PPO rolling over, starting to turn down. Typically when you see it start after moving higher, it starts to roll over like this, you get these bullish crossovers, thereby confirming the divergence. Once in a while, you can see it start to turn down as it did here, and then it bounces off the signal line, the 9 EMA. So once and if, when we get a bearish crossover here on the PPO, it will confirm these divergences. I don't know if that happens here. It all depends what happens next week. If we go down next week, we'll have a bullish crossover and confirm bearish divergence. Just looking at this chart alone, my guess would be, as I said, that the SPY pops up, makes a new high. I've drawn it out here. You can see this line here. This would be your divergent line. So to kind of give you a scenario, one scenario. Now, I most certainly, I'll say this, there's not enough meat on the bone for me to try to go long, if we're going to get a pop, because by my guesstimation, based on the view of my view or read on the charts, both the daily 60-minute chart and other things, I see about, give or take, about 1% upside on the SPY before it rolls over. And so if we do pop next week, we get a little bit higher high, then we turn down here in the RSI, we turn down in price, that will have confirmed this divergent high. And again, this is just one series of consecutive divergences. And I've stated this many times on the site for those of you that say, well, these divergences don't play out in the market. I cannot reiterate enough, they do play out. They all don't have to play out for a bear market or a drop of 10% or more. You know, they play out for tradable corrections. The point is they almost always play out. We didn't have a divergent high right there on the RSI. We only had it on the PPO, but we still got a little drop. Now we have, at this point, we have negative divergence, clear, very clear negative divergence. And this is my point. It would take a heck of a rally. Sorry, wrong drawing tool. It would take one heck of a rally for the market to burn through these divergences. By burn through, I mean we have to then take out this previous reaction high over here, right here, in the RSI. Same with the PPO, or if you're using a MACD, it'll look very similar. We'd have to take those out. So it is possible. And again, that's why I refer to this as potential divergence, not confirmed. Confirmation will come on a bearish crossover there of the PPO. So that's my ideal scenario. And if you take a look at the 60-minute chart, these are really good to sort of hone in on your timing. Here's a couple things that I noticed. This is a 60-minute chart, and I do have a PPO up on this one as well in lieu of a MACD. Couple things I'll point out. The PPO is bouncing off the zero line, which often acts as support. And this is also a good trend indicator. Typically, when you have the PPO, and I use the 9 EMA, the white line, which is the last of the two to cross. When it's below, the trend is bearish. And when it's above, as it was back here, the trend is bullish, as you can see above. Pretty accurate trend indicator. And again, this is commensurate to the time frame you're trading. This is a 60-minute time frame, so these aren't primary trends. This isn't what you trade your 401k with. This is just if you're a swing trader, you're in and out for a few days. This is one thing. So right now, this is still bullish, the fact that we're above the zero level, and as you can see here, the PPO is turning up. So this leads me, you know, my best guess, I should say, will be to see a little more upside, maybe a pop on Monday. You know, markets will be closed in another hour and a half. It's Friday, about 2:30 as I'm doing this, 2:30 Eastern time. So ideally, you can see here a little pop and then a reversal. It'll keep those divergences intact. It would also give us a really nice breakout to new highs. This would just, it doesn't have to happen, but it would be actually a preferred scenario if you're bearish looking to short the next move down to see a breakout of the March 1st highs. Remember, this is so far the highs in the S&P 500 were put in back on March 1st. We're just below those. As I mentioned, typically it's like a magnet when you get near new highs like this. From my experience, more often than not, they're going to run it. They're going to take out those levels. You have a lot of bulls wanting to go long, shorts that will cover. And so an ideal scenario would be to see a failed breakout. You get the breakout to new highs. Again, you know, they cheer it on TV, CNBC, everything's S&P 500's at new all-time highs, blah, blah, blah. Longs go jump in because, you know, on face value, any security making a new high is bullish. The reason being is at that point in time, you have zero, absolutely zero buyers or holders of, in this case, the SPY underwater. Everybody's profitable. Therefore, everybody's happy and you don't have a lot of remorseful people trapped and waiting to get out. That's on face value what makes new highs bullish. However, I've gone over this chart in the past. You know, every sharp correction drop in the market in recent years has come almost always on a marginal new high, and that's when you get those divergent highs. So there are differences. I don't always expect a false breakout on every break, false breakout on every break to new highs. In fact, there are some that I take as buy signals very often. But a divergent high I do not chase when we have strong divergence, and most importantly, not just here on the 60-minute chart. That is significant, you know, in the shorter term time frame, but more importantly on the daily chart. So therefore, these are the type of breakouts that if we get it, and as I said, I'd lean towards it. I'm a little better than 50-50 that we do get that next week, a little pop up there, and then put in these confirmed divergences here in reverse, and that will be a failed breakout. And as I often say, fewer things in trading are more bearish than a failed breakout. Anything else to note here? Maybe a minor trend line. Yeah, we could draw a little bit of a trend line. You can sharpen that up going down to a 15-minute time frame, and that's something to watch for a potential sell signal. Keep in mind, you want to see a 60-minute close below this trend line. There's a little intra time period break, a 60-minute candle, but we snap back above there, and it's all about the 60-minute closes when trading off the 60-minute charts. So that's the SPY. That's my preferred scenario. But you know, here's the thing: the leading index, you know, it's been the tech stocks, the big FAAMs, FAAMG, Facebook, Apple, Amazon, Microsoft, and Alphabet. Symbol GOOG. That's what's been holding this market up. And here's the Qs now. We have a divergent high potential. It's not yet confirmed. I put a yellow line there to show you. You can see the PPO rolling over. And as long as we don't take out this yellow line, we still have the potential negative divergences. The yellow line just represents the previous highs, both in the RSI and in the PPO. But these white lines show that if we turn down before then, and that would be ideal. You can have equal highs on the indicators with prices making higher highs and still have negative divergence. But it's ideal to see lower highs on the indicators and higher highs in prices. So, you know, this is just, like I said, about a 3% pop over these recent highs where I put the crosshairs. Not very much, not very impulsive or convincing in my opinion. And then when we zoom down to the 60-minute time frames, we can see this little divergent high right here on Qs, on the Qs. So here you could draw a little uptrend line, broke below it, but there isn't any impulsive selling yet. And if the Qs, let's just say my SPY scenario plays out, we get a little pop into next week to put in one more divergent high. Well, keep in mind, we have divergence already in place right here from back the other day. We have the negative divergence. It's not very steep, but it's there, and it's relatively small. But keep in mind that another pop up will put in a second divergent high. So it would look something like this. Let me draw it out for you. You know, this is the indicators here. So we draw the line like this, continue that line. There's your negative divergence. There's your divergent high, and then boom. So this scenario, I will say, is my preferred scenario for both the SPY, the Qs, and of course probably going to bring the small caps with it. Maybe, maybe not, because I don't think it's very long. And again, I'm talking maybe 1% or so. So that's my thoughts. I think we'll see this, you know, the market peak next week, at least, you know, for the next, you know, decent pullback here. Decent meaning 3% or more. And there is certainly the potential in the charts. Again, that's what I've been pressing for a long time for a much deeper pullback. All right, let's look at the FAANG stocks, or FAAMG stocks, and then we'll wrap it up. We'll go in order of market cap. Here's Apple. I've put up this chart quite a bit recently. You know, before the earnings report, I expected one more thrust up within the wedge. So far, that's what we've had. We found support. It looked, you know, Apple sold off in after-hour session after earnings, but recovered, found support on the trend line. And again, this is the same exact trend line I posted, you know, before we even hit it, or back here. I think this was our earnings candle right here. So you can see we pounded right off or kissed it perfectly right at the bottom. You can see that little candlestick shadow down there, that tail. And then we've moved higher. We put in a new high today in Apple. And that was my expectation based on the look of these divergences. I figured we'd get one more thrust. But now this is a bearish rising wedge that is what I refer to as fully mature. By that I mean this is the point where somewhere in this range where wedges usually break down, and that is a function of where they are in relation to their apex. And apex is where obviously you have a wedge and the two lines meet. So if you extend these lines, you have to go to the left of the chart, and it varies. You know, I've seen writings sometimes say 65, 70%, 80%, but we're close enough into that wedge. Usually prices don't break out right at the end, the apex of the wedge. They break out in this sweet spot here. So Apple's ready to go. It has the divergence in place. You know, I'll tell you, I bought some QQQ short positions today, or added to some QQQ short positions today. I don't have a lot in the Qs, but I am waiting when Apple breaks and these other FAANG stocks. It's going to be a nice ride down, in my opinion. I'd probably come back down here to test backfill the, at least to come and test the top of that gap right there from early January. And that's a considerable drop in Apple, and that will have a considerable impact on the broad markets. If that's the case, that's almost 15% drop. So I see good things to come. Just have to be patient. These charts are continuing to develop bearish. And again, you can go back in time. These divergences do play out. 12% drop in Apple back on that last divergent high right there. Let's look at Alphabet. You can look at either share class. I'm just charting GOOG here instead of GOOGL. The bigger picture is this large divergent high, and yes, I've continued to expand. This line gets dragged. That's how divergences work. I say this all the time. Divergences in themselves are not a sell signal. Far from it. They're just an indication of an impending trend change, as long as they're in place. And we had divergences here, and we've moved higher in Alphabet, but we've not even come close to taking out the previous reaction highs here on the RSI and the PPO. In other words, these divergences are still in place and would be unless those previous highs were taken out. So there's Alphabet, extremely overbought. I mean, we just tapped, what is that reading? A 90 on the RSI? Crazy overbought. And yeah, as good as the fundamentals in these companies are, they're just too overowned and overloved right now. A little bit of divergence. Even if we pop higher, we're going to have some negative divergence on the 60-minute chart here. So there's Alphabet. I won't get into it too much. Just keep an eye on it. It's not my favorite. If I would short, I can tell you right now, I would short Apple before I'd short Alphabet. Here's Microsoft, same story, divergent high. You can see the PPO starting to turn down. RSI is turning down, thereby confirming the divergence here at that high. I haven't even looked at the 60-minute chart. Actually, nice little divergent high recently. You can see that on the 60. Here's your divergence on the PPO and against prices there. So keep in mind these guys trade what they are the market. They are QQQ, which has led the market. So if we pop next week, they're probably going to go up, but it's hard to say. These guys are getting pretty heavy lately. They're going to collapse under their own weight sooner than later. Here's Amazon, divergent high, a small divergent high, about equal highs on the PPO here, maybe a slightly higher high, negative divergence on the RSI. Little wedge type pattern within this larger wedge. You can see there that little wedge shows up better on the 60-minute. There's your negative divergence on the 60-minute chart. Breakdown. It's not impulsive selling yet, like you want to see on a breakdown. Plus, we have this trend indicator just now testing. It's still bullish right on the zero line, the PPO. There's pretty nice. There's a gap right here as well as this reaction high. So if you ask me what's the magic number near term on Amazon, it's about 924.80 or so, somewhere in there. We need to see that level go. And remember, take these charts of these 5 leading stocks in collectively. You want to see at least 3, if not 4, of the 5 breakdown below these support levels that I'm mentioning here. Here's Facebook, negative divergence on the PPO. We had negative divergence on the RSI, but we just hit an extreme, rarely seen overbought reading, almost close to the 90 level. And this, to me, looks like a beautiful wedge overthrow. I left this line here. I could have extended this white line, pulled it higher on that recent pop, but I didn't, because we have so many reactions here. 1, 2, almost 3 there, 4, 5, 6 touches. And we had a lot of touches here on this line. Look how well that upper trend line defines that wedge. So this is the larger wedge, the larger divergence. This white line and this white line show the smaller near-term divergence. And this is one of my favorite chart patterns in trading, is when you have on a bearish rising wedge, which we do in this case, and we have right around the apex where that wedge would normally break out, not at the apex, I should say at the sweet spot. You have a pop above the wedge, and then followed by a reversal back down into and below the wedge. That is one of the more powerful breakdowns I've seen. And I use that just as well on the bullish side, on a bullish falling wedge, when your prices drop down below the wedge to the downside and then shoot up through. I call that a wedge overthrow. And so far, that's what it is. That's a little circle, that area there, if I could. There's the overthrow. And so something to watch for on Facebook. If we do see move back down into that wedge and down below, this one has a lot of hot air to let out. And that's it. That's the big five. I think I covered everything. And in a separate, either a separate video or a static post, I'll do an update. Had a couple requests on gold and oil. I did put up a chart and my thoughts, a couple charts actually, of oil within the trading room. And I'll either get those out in static charts or maybe do a quick video on oil and gold and anything else you guys want to hear. All right, this has been Randy Finney. I hope you have a great weekend, and see you guys in the trading room.